Hello, good day, guys. My name is Nick, technical analyst with SuperForex. Today, we shall be looking at a technical analysis on the currency pair, the United States dollars to the Japanese yen. And as usual, we shall be talking first about fundamental analysis before we move right down ahead to technical analysis, which is purely what we're going to be seeing on the chart. We have noticed that the United States dollars Japanese yen has dropped to a near 3-week low on Tuesday amid a global flight to safety. And escalating the Russia-Ukraine conflict has triggered a sell-off in equities and has benefited the JPY. And mainly the key points for today is a goodish pickup in the United States dollar demand has assisted a pair to stall the slide near the middle at 1140s. So now what to learn from this is that the United States dollars Japanese yen pair has come under some renewed selling pressure on Monday and has fallen over 40 pips from the daily swing high, as we can see, around the 115.10 region. And of course, the downward trajectory extended through the first half of the Asian session on Tuesday and was sponsored by the global flight to safety amid intensifying Russia-Ukraine tensions. In fact, our Russian President Vladimir Putin has opted the ante in the crisis that could unleash a major war and recognize two Russian separatist-held regions, the Donetsk and Luhansk, as independent. And Putin has later ordered to deploy troops into the area to maintain peace and fuel areas about a full-blown East-West conflict. And the development has tempered investors' appetite to perceive risky assets, which was evident from a sell-off in the equity markets. And this, in turn, has forced investors to take refuge in traditional safe haven assets, including the Japanese yen, and drag the pair to a 2.5-week low. Now, the nervousness is the bid after the Russian envoy to the United Nations, Vasily Nebenzia, has said during an emergency UN Security Council meeting that we remain open to diplomatic solution. And this, along with a goodish pickup is in the US dollar demand, has assisted a pair to make the reverse down to the 1140 meets. And that said, any meaningful recovery still seems elusive amid a sharp decline in the US Treasury bond yields, which might have acted as a headwind for the buck. And hence, it will be prudent to wait for stronger follow-through buying before confirming that the recent pullback from the vicinity of the multi-year high around the 116.35 region has run its course. Market participants now look forward to a release of the flash US manufacturing and services PMI due later during the early North American session. And the focus, however, will remain on the situation in Ukraine, which of course will play a key role in driving the broader market risk estimate. Now, the technical outlook, what we're already checking out of this is from a technical perspective, the pair has managed to find support near the 61.8% Fibonacci retracement level, and of the 113.47 has made a 116.34 move up. The said support made mid 114s as should now act as a pivotal point for traders, which if broken decisively will set the stage for additional near-term losses. So the pair might then accelerate the fall towards testing monthly swing low around the 114.15 region, turn vulnerable to break below the 1140 mark. Now the downward trajectory could further get extended towards the next relevant support around 113.50 to 113.45 area, or the YTD low touched in January. On the flip side, the 50% Fibo level, just ahead of the key 115 psychological mark, now seems to act as an immediate hurdle. So any subsequent move up is likely to confront stiff resistance and meet with a fresh supply near the 38.2% Fibo level around the 115.25 region. Sustained strength beyond will negate any near-term negative bias and trigger a short covering move towards the 115.65 zone or the 23.6% Fibo level. And the momentum could eventually allow bulls to reclaim the 116.00 round figure mark and lead the pair back towards the multi-year high around the 116.35 region. Now, if we were to make an entry to the trade from this point and looking out for first most recent resistance zone at 115.101, we're looking at about 47 to 50 pips from that entry point, which is good money, and most likely an extension to the upside. We're looking at nothing less than 150 pips from the trade, of course, which is good money. Today we shall be looking at the technical analysis on the commodity Amazon. And as usual, we shall be talking about fundamentals, and then we'll move right down ahead to technicals, which is purely what we're going to be seeing on the chart. And we have noticed that tech dominated growth stocks are still not cheap, despite some sharp falls over the last 6 months. Analysts at US Investment Bank has noticed that JP Morgan has been cautioned on Monday. The so-called finds have seen off-year COVID era surges caught back this year with likes of Facebook down, Apple down, Amazon as well down, Netflix and Google as well down by 35%, 10%, 5.7%, and about 8.5% respectively. Now, JP Morgan's analysis estimated that on every average tech firms that are yet to even make a profit have lost 30% of their value since peaks around September last year. Why? Fintech firms, which focus on tech-savvy banking apps and tools, have dropped 40%. And as good stocks weakened of late, they are derated but are still not outright cheap. And JP Morgan analysts have said that in a note to our clients, adding that banks and commodity-linked stocks, which have rallied this year thanks to rising oil and metal prices or interest rates, were still far, far more expensive. And the chance is the earnings of growth sectors might not be exceptional anymore, although the big driver remains that the bond market borrowing costs, which have shot up this year as top central banks have laid their groundwork for interest rates. And years of record low rates have fueled the tech stock rally, but with those rates now rising again, the appeal of stratospherically valued tech stocks gets dimmer for investors, especially if their growth trajectory is splotter. So we believe that bond yields will keep moving higher through the course of the year, as JP Morgan said, referring to the bond market cost. So our fixed income strategists expect US 10-year Treasury yields to reach about 2.35% by the end of this year, and the German 10-year yields to reach about 0.5%. Treasury yields are now at 1.92%, and Germany bonds are at 0.2%. And they also said that the tensions are, building between the Russia and the Western powers over Ukraine shouldn't drive a return to big tech names, which carved out a safe haven reputation during pandemic. So purely what we're seeing on the chart, we have noticed a test of support 2 times, ranging from this gap here 2 days ago. And we have noticed that the first touch at this point, and then the second support zone still measuring at this point at 3019.91 for Amazon. So now a retest is most likely going to happen, but first a shoot up back to this resistance point a little bit, and then a final retest before most likely a shoot up to the upside, and a safe haven of the 3306.26 zone, about 200 and something pips thereabout, which is good. So if you want to make an entry at this point and having a confirmation on your 4 hours time frame, we have seen that a retest most likely going to happen with the inverted hammer, which signifies reversal, and then a push up to this zone, and then a much extended zone at 3251, of course. So that's our technical analysis on today's commodity, Amazon. I remain your host, Nick. Bye for now.